All right, guys. For YouTubers, it's August 15th, a Thursday. Headline driven, everything from the downside yesterday to the upside Monday and everything else in between. We're bullish, then we're bearish, headline to headline. All right. Headline to headline means what's dropping down the wire, what's driving the markets, U.S. China trade. Market's sick of the U.S. In China contingents just with rhetoric, and they're like, show me the signatures. But at 6:30 a.m. Central Time, there were some comments that were kind of upbeat about meeting halfway. I think the market took it as meeting halfway, and China, what they really was saying was that U.S. got to come halfway. But either way, they took it as bullish, and it was bullish, and it was easy to react bullish. Now, it doesn't mean that you're in front of your desk. You got to know why it happens. So if this does happen when you're in front of your desk, and some of our group were able to catch this. Take a look at the right side of the screen. They're able to catch this pop from 36 to 66 in a very, very short period of time. If you don't get long, you certainly aren't getting stuck short. If you were looking to get short, you get the hell out of the way. You know something's not only bullish, you know how bullish it is. So keep that in mind when you're trading, that if you're not privy to what's driving the market when it comes out in real time, I don't care if you make money on it or not. You could save money by getting out of the way. Everybody invests their education in books and strategies and indicators and system or your profile, things to give them an opinion. Well, the damn fundamentals are going to give you the best opinion. All right. And the fundamentals is what's driving the market. Geopolitical events, earnings, central bank action, inaction, all kinds of things. Unfortunately, terrorist attacks, and gladly they don't happen often, but it's those things that create movement, price action, that is your job as a trader to trade. Your job is to trade prices as they change, because they get expensive and they get cheap. No price goes down unless it's expensive, or goes up unless it's at some point cheap. It's deemed to be cheap in here because the market then had to price in maybe a trade deal. But like I said yesterday, live in the room, like I've been saying the last couple of days, and including today, that the market and investors are too smart to say we're going to continue to just rally and think life is good on rhetoric. It's too many G20 meetings that they come out of bullish for a deal, and we don't have a deal. So they defer tariffs. Okay, fine. They go up, and too bad. We don't care. You've done it before. Fool me once, fool me twice thing. So you can see this market then starts to move down into a consolidation range. Now I'm reviewing this in this highlight, but in the room, we're reviewing and previewing what could happen. What's important was, will they get back to 36, ground zero? 36 is also essentially yesterday's close at 3:15 Central. And it also became the session low. So as we moved through the day, it wasn't particularly easy in the first hour and a half. You had to be patient. Hopefully yesterday taught people that. And we started to look back and say, hey, you know what? In the low 40s isn't going to hold forever. And then 38 wasn't going to hold. And the other guy in our room, Tom, come up with a great, just the way things were going, that we're going to test again the regular trading session low, which was also yesterday's close, which was also ground zero from the China comment, and then bounce and rally. And he said that when we were in the low 40s. So let me fast forward ahead and just go over this so you can understand. Let the other people get stuck long at the bottom of a potential breakout. So there's two of them right in here. I was talking about at some point they're going to break through the low 40s, and I didn't want people to continue to try to get long looking for this rally and then get short looking for this break, play the top and bottom edge of the box. Unless you've been doing it and getting paid, the time you do it is the time it's not going to work and break out. That's the problem with selling the top of a range and buying the bottom. If you had been doing it, predicting that was going to be the range, you got some money in the bank, you got some money to play with. So when you do play it and it doesn't work, you only lost some of what you had made. But at some point, you're going to get the low 40s, which was the bottom of this whole box, to give up. And so what did they do? They did a little dance, little head fake we talk about in those patterns, and they break them. Then the next thing that was interesting, they created another box, 38 to like 41. And walking guys through this, and I said, I get anxious to want to sell the bottom of this box. But what I try to do, if I'm having trouble reading it, if I sell 38s, I'm going to probably puke them at 40 if I'm wrong. 42, 41 to top, not 42, but 40, 41 top of this. So instead of getting short 38, hey, if it goes down, great. But if it comes up, I'm going to get in where I'd get out. And so what it does is it allows you might miss it, but it was right in here where I said, I feel anxious to get in. And if I did get in here, I'd puke it here. Get in where you'd puke it. Now you're able to sell the stretched rubber band. And if you're wrong, you're wrong, but you're wrong at 40, 41. You're not wrong at 38. Big difference. So you give yourself better chance to break out and test. Indeed, the regular trading session low, yesterday's close in ground zero, which was 34 to 35 half area. Sure enough, it goes down there. I told guys, based on what Tom said, based on those levels, to not be a hog through there. You got to do your due diligence and cover your short, your entire short, if you only got one left. At least some of it, most of it, if you got multiple contracts on. And so the market bounces pretty aggressively and rejects that area. Second time it went down there in the first 90 minutes and bounced. And so now, like I said yesterday when we did this highlight, don't be surprised if we're trading 40s, trading 20, 30 lower. We did because it just had that negative capitulation. They're going to squeeze these longs out, and we're sick and tired of the rhetoric. The 210 yield had flipped and everything else. Now, because of this rejection twice, it could always go back down there. Always leave yourself open for a retest and for a bearish outcome. Always. However, there's, I think, better chance they start taking out some of these consolidation tops, that they retest this 54, 55 area that they laid all in here, so many swing highs on. Then they could go to the spike high of 66 after the Chinese comments and then see what's above there. I don't think they get overzealous to the upside until they get some more concrete evidence that there's a deal, closer to a deal, something that's just not talk. I get mad when people hear from other people that, you can't trade news, you can't trade BS. You can't if you don't understand it. They're right. You better be able to either trade it, at the very least understand it, to know what the market's pricing in. As a trader, not an economist, not a pundit, not someone hosting a business channel. Understand it as traders that, hey, this is driving the market. This is what you could anticipate as a headline. And then you're in front of a news source in a room like ours to get you privy to what's going on when it's going on. Not necessarily when someone would tweet it 5 minutes later or come across a news channel, but in a timely fashion. Hey, we're rallying 2 points, and this is a real bullish comment, and you could buy it after 2 or 3 point rally, and it immediately goes another 4 or 5 points. Diligent reaction. Be aware of your surroundings. Everybody probably drives a car. Know if someone's in your blind spot before the clown in front of you slams on his brake because he doesn't know how to drive. Scoot your ass over. Driving could be very dangerous, but you're not biting your fingernails scared every time you get in the car. Same thing with trading. It could be very dangerous, but you can't be so risk adverse as to be fearful to get in or to get out once you are in. So relate things back to something else. It's the only way you find value. In this analogy, driving a car could be dangerous, but you're not scared out of your mind every time you start the car up. Keep that in mind in trading. Stop worrying about how bad things could be. Just do your job. Your job is to trade price. Your job is to know when the market might be looking a little bearish. Your job, like right now, to know that we just slipped through the middle of this consolidation box, we say all the time, it's kind of a lookout below moment. They can't get up through there. The middle of this box is not arbitrary. Once it got through there, what happens in the box, talk about consolidation boxes all the time. What happens through the middle of the box? There are more people who are long that have grapefruit eyes. And when you get a lot of grapefruit eye longs, there are sellers that push price lower. So what's important is the middle. They should hold it as resistance and try to attack these lows. They creep back above it, they'll attack these highs. Continue to strip the randomness out.